And joining us now with more on what is driving this historic global stock rally is Jim Awad, chairman of Plimsoll Mark Capital, and Ibrahim Gassambe, equity strategist for Rabini Global Economics. Gentlemen, thanks for joining us.
Pleasure.
Thank you.
Jim, we'll start with you. The fundamentals do not seem to be supporting these rallies. The U.S. GDP missed estimates, China's GDP missed estimates. What's going on?
Well, the big picture is you're in a world of subdued growth, but growth. 2% in the United States, 7.5% in China, 5% in India, 0% in Europe, with almost no inflation, no yield on cash, very little yield on bonds. And what investors are saying, in that environment, if you can find stocks with a dividend and with 4 or 5% growth that can give you a 7 or 8% total return, that's as good a place as any to be. It's better than being in cash, better than being in bonds, better than being in sovereign debt. And meanwhile, growth is slow enough, so commodities aren't doing well, gold isn't doing well, so by proxy, it's stocks.
So the lesser of all evils, Ibrahim, would you agree with that? There's not much money to be made in the bond market, for example, so equities are your best bet?
Exactly. This is the main story, the main narrative that's been driving markets for several months now. You have the low growth story, but at the same time, you have central banks easing. And in that environment, where do you get extra returns, right? You have to search for yield, and that has been the global hunt for yield, moved across the entire bond market, and now needs to move across asset class into the equity for better returns, because the bond market just doesn't offer, on a risk-adjusted basis, the returns that investors are looking for.
And that's a big concern. The central banks have been pumping stimulus into various economies around the world. Many are saying that these rallies are artificial, central bank infused. What happens when the central banks can't do this anymore? I mean, there's a limit to how much stimulus banks can do, from the Fed to the ECB.
Well, I have to digress a little bit from that argument where it's not purely based on liquidity, because there's been some improvement in the growth outlook, especially the U.S. medium-term growth outlook. You have housing market recovering.
But that's fueled by the Fed. That's part of the Fed's strategy.
That's part of the Fed's strategy, but this is a real, actually, impact, a real economic impact. It's not purely based on money and financial asset reflating just because you have the reduction in maybe tail risk and nothing fundamentally changing. You have fundamental changing. And even on the equity side, you've seen record performance in earnings, which the market multiple didn't catch up until lately.
Now, Jim, I want to bring you in, because when we speak about earnings, we've had the majority of S&P 500 companies reporting so far, about 85%. Many, about 68%, have beat on earnings. Very few have beat on revenue. In fact, a lot of disappointment on the top line, the revenue, which says they're not expanding in terms of sales. So how can this continue? Well,
it is a slow growth environment, but the point is, if they can get positive sales, even if it's 1 or 2 or 3%, which is possible with the growth of 2% in the United States, 7.5% in China, and 5% in India, and 0% in Europe, you can still globally grind out 2 or 3% revenue growth and 5% earnings growth, and people are saying that's still the best place to be relative to what the alternatives are. So nobody's talking about a high growth environment with spectacular returns. They're saying by proxy, with all this money being printed, well, we have slow growth, and if anything, there's a risk of deflation on the other side. You'd rather own corporate equities with a global footprint and dividends than anything else, and that's what's driving
But from a macroeconomic point of view, is it not a concern that the revenues have been disappointing? I mean, a company can manipulate to a degree its net income by cutting costs and so forth. And I see, Ibrahim, you're nodding in agreement. Shouldn't we be worried that sales aren't really expanding?
Exactly. This is the main concern of us. I think the story, the growth story remains discomforting. But at the same time, it's the expectation. The market really doesn't look at. You have near-term expectation, one, and you have also medium-term expectation. The biggest risk to market right now, from my perspective in the near term, is disappointment from the expectation on CapEx spending from corporate. CEOs' confidence are very low, and you have excess capacity in multiple industries right now. Out of maybe 15 out of 22 industries, you still have a big slack in it. How can you expect capex to pick up in the second half, which is part of the big argument.
So Jimmy, what do you think? What's
Well,
the outlook for the second
is
half
that
of the year?
the market will keep going unless there's a disappointment or a surprise geopolitically.
What is it going to take to derail
Well,
us?
you could have there's a lot of speculation in the credit markets, and it's worrying. It's going back almost to 2007 levels where you're getting debt without covenants, where you're getting junk bond yields coming down, exotic derivative securities. So if you got a blow up in one of those areas because the Fed is inducing speculation and a risk on trade, that could bring the whole thing down. A war someplace could bring the whole thing down. Or if that doesn't happen and we just continue to, eventually stocks will get overvalued. People are saying they're at 15 times, they can go to 20 times. Well, let's assume they go to 20 times earnings and the economy doesn't get better. Well, then stocks will just stop going up on good news, and you'll know that the bull market is over. So it could be disrupted by an accident. If it's not, it'll end with stocks being overvalued and just simply stop going up. What you have to worry about is how do the central banks get out of all this money printing?
Because we've seen when central banks, when the Fed hints at slowing down its stimulus program, we've seen markets do a major pullback. So how do the central banks get out of it?
Well, from an equity market perspective, it's not necessarily that whenever you see the central bank easing back on
but that's the reaction
accommodation
we've seen in the markets.
Yeah, but the central bank can hike rates, but as long as the rate hike is in conjunction with improving growth, the equity market can further go up.
Well, that's what they're betting, that will eventually lead to growth. What you worry about is they've done this and they've bought $85 billion more, huge amounts of money, and the economies do not accelerate beyond the 2% growth. And then you've got all this money out there, and the question is, so you've got all the money, and this is the best you can do, and what are the implications of that in terms of asset bubbles and credit bubbles? That we don't know, but that's something to worry about a year or two from now.
A year or two from now, not yet. So not sell in May and go away, as has been the trend that's worked for 3 years.
What I'm saying is stay in, but people tend to want to increase their risk as markets go up, and what I would say is reduce your risk. Stick with the highest quality fixed income, the highest quality equities. Stay in, but start to reduce your risk exposure, because one way or another, this will end up possibly in an unhappy fashion.
You're both nodding very quickly. Ibrahim, S&P target for the end of the year?
Our current target is 1630. The market is pretty close to that target, but we still are constructive on equity, especially because you don't necessarily to stop at fair value. Liquidity can push you beyond that.
Jim?
That scares me. The fact that people would stay invested hoping stocks get overvalued. What I would say is the trend is up, but that you've probably experienced percentage-wise the majority of the gains from the low to the high. So stay in, but keep your guard up. Don't get sloppy.
Getting 1 foot out the water slowly.
Well, just increase your quality. Don't decrease it, because what you don't want to do is make the money and lose it on the other side.
Right. Okay, we're going to have to leave it there. Thank you so much, Jimmy Awad.
Always.
Thank you
and
very
Ibrahim
much.
Gassambe. Thank you so much. That's Ibrahim Gassambe, equity strategist for Roubini Global Economics, and Jimmy Awad.